What if I told you the rich don't avoid debt, they weaponize it? While most of us see debt as a trap, the ultra-wealthy see it as a turbo button for their money. And no, this isn't about maxing out credit cards. This is about strategic leverage, the secret engine behind generational wealth. So how does it actually work? Let's break down the 3 superpowers debt gives the wealthy. First up, aggressive growth. Think of leverage like a financial magnifying glass. Put down 20% of a property's price, borrow the rest. If it goes up 10%, your return isn't 10%. It's 50% on your actual cash. But wait, what if it goes down? That's the double-edged sword. Leverage amplifies wins and losses. The wealthy manage that risk with diversification.
Superpower number 2, wealth preservation. Here's the magic trick. Borrow against what you already own without selling it. Why sell a stock that's gone up and pay taxes when you can just borrow against it, keep the stock, and invest the cash elsewhere? This is called buy, borrow, die in fancy circles. But let's keep it simple. Don't trigger taxes if you don't have to.
And speaking of taxes, the third superpower is where it gets really clever. The tax shield. In many places, interest you pay on investment debt is tax deductible. So if you borrow at 5% but are in a 40% tax bracket, that debt effectively costs you only 3%. It's not free money, but it's cheaper money. And when you're deploying millions, cheaper adds up to massive.
Let's talk real estate, the wealthy's favorite playground for leverage. Why? Because banks love lending against bricks and mortar. Strategy 1, the bridge to agency. It's like a financial pit stop. Get a short-term loan to snag a deal fast. Then, once the property is stable, refinance into a cheap, long-term loan. Boom, locked in. Strategy 2, negative gearing. Sounds scary, but it's just using paper losses to shrink your tax bill. Your rental property loses money on paper because of mortgage interest and depreciation. That loss offsets your other income. Less tax, more keep. It's like getting a discount on your taxes by strategically losing money. Only in finance, folks.
But what if you don't have real estate or stocks to borrow against? Get creative, like borrowing against your art collection. Art-secured lending. The bank loans you about 50% of your painting's value, you keep the art, get cash to invest, and hopefully the art keeps appreciating. It's like using your vintage comic book collection as collateral for a business loan. Nerdy? Maybe. Genius? Also maybe. The golden rule across all these strategies? The loan-to-value ratio, or LTV. How much will they lend against your stuff? Real estate? Banks might lend 80%. Fine art? More like 50%. Why? Art is harder to sell fast if things go south. This leads to the biggest risk, the margin call. When your collateral drops in value, the bank says, hey, add more cash or we sell your stuff. Remember that tax shield? A forced sale can trigger a huge tax bill you were trying to avoid. Ouch.
So how do the wealthy sleep at night? They don't bet the farm. They diversify collateral, use fixed rates when possible, and always have a backup plan. Let's zoom out. The core playbook. 1. Use debt to control bigger assets. 2. Borrow against winners instead of selling them. 3. Make interest payments work for you via tax deductions. It's not about being reckless. It's about being strategic. Debt isn't the enemy. Misunderstanding debt is.
So what's one asset you own that could potentially be leveraged if you knew the rules? Drop your thoughts below. And click that subscribe button and hit that notification bell. Remember, leverage is a tool. Use it with knowledge, respect the risks, and maybe, just maybe, build something that lasts. See you in the next one.